Hello Sector Watchers, welcome to the show. This is the 58th episode of Sector Spotlight on Tuesday, the 1st of December, recorded on the 30th of November. My name is Julius de Kempenaer and as usual I'm hosting the show today. I love to hear your thoughts and ideas. My contact details are on the slide and I love the interaction. It actually keeps me on track and often gives me ideas for future shows or blog articles. Also, the comment section on every video or article is a good place to communicate. Today we'll go over last week's performances and what that means for the rotations on the daily RRGs for both asset classes and sectors. After the break we'll try to put everything in a bit longer term perspective by looking at weekly RRGs in combination with the weekly bar chart, price bars and relative charts. And as this is, at least when I record it, the last day before the start of the new month, we'll bring in the seasonality for you as sectors and try to see if we find any rotations that align with very strong or actually very weak seasonal performances, and that may give us a clue on any particular strong or weak patterns for the month of December. But first, let's have a look at what happened. Last week, let's take a look at the performance and overviews using relative rotation graphs for asset classes and sectors. As usual, you'll find the asset classes on the left and the sectors on the right side of my screen. Starting with asset classes, and I've sorted the table here on performance, and you can see that commodities had another good week, up 4.4%, stocks up 2.2%. The second commodity index that we're tracking, that's the Bloomberg one, that has a lot less energy, oil in there, still up 1.9%, and the balanced index fund up 1.3%. So in general, a good week for 60-40 balanced portfolios. And then underperforming this week were corporate bonds, high yield corporate bonds, investment grade corporate bonds, treasuries, with a marginal rise with 10 basis points, and then in absolute terms negative returns for real estate, V&Q, and the US dollar actually down 50 basis points. If we look at the RRG, then clearly that commodity tail for GSG is doing very nicely. The stock market lost some momentum, but last Friday started to move to the right again. I'm recording this on Monday, so today so far has not been great. We're lower, we're recovering a little bit at the moment. So you see that the lengths here are shortening. So still pretty strong, second on the list if you measure on RS ratio. The second commodity index is picking up a little bit of a jiggly pattern here in lagging, so not fantastic. If you want to do something in commodities, I'd say you should be with GSG, with the GSCI version. High yield, moving left, losing route strength, picking up a little bit of momentum, but not much. Investment grade, almost vertical, picking up a lot of momentum, but no relative strength. So that means that most likely it's a recovery in that relative downtrend versus VBINX. We have commodities. We saw that one picking up strength pretty much all of last week, if you look at the return there, but now it starts to move to the left. A weak asset class, especially compared to stocks. So even from this RRG, it's pretty clear that stocks are to be preferred over government bonds, big time as a matter of fact. And then we have V&Q rolling over. We had that strong move, but that's now losing relative strength, relative momentum since last week. And then we have the US dollar, which is positioned way to the left inside the weakening quadrant, and moving further down to the left. And this is compared to VBINX, to the benchmark. We'll take a look at the US dollar chart later on. If we move to the RRG for sectors, then again ranking that on performance for last week, for the last 5 trading days ending on Friday. Strong week for energy, but losing, the best has gone, so to say. Oh, wrong chart. So if we go here, see that it started losing relative momentum, but in the short term, energy was by far the strongest sector. Still looking good. If we're going to put it into a bigger perspective and look at the weekly, I'm not so sure about it. But if you want to swing trade, then energy definitely a good sector to do that. Financials lost a little bit of momentum, but still holding up in terms of relative strength, so that's good. That was here, and then we have materials, short tail on the right hand side. As you know, that means that it's a stable relative uptrend, so that is good news. And what we can see here is that it actually started to curl back up. So we went through some sort of a correction, and we're now moving back up, and it looks as if we are moving back into the leading quadrant soon. So materials remains strong. And then we have communication services. It's hard to see because it's actually right on top of that axis, and it curled up. So I hope you can see it on my screen. So you see here it touched the lagging quadrant just very briefly, and then started to move up in four days in a row, with momentum rising and relative strength at roughly, let's say, 100 rounded. So picking up there, and it starts to improve. I mean, especially if we can start to pick up relative momentum and push that tail to the right and back into the leading quadrant, then communication services could be an interesting sector to watch in the coming week, maybe weeks. Discretionary, nicely positioned inside the improving quadrant, nice strong tail pointing towards leading, so that is actually doing pretty well, and it was outperforming SPY last week. And then we go to the sectors that underperformed SPY at least over the last 5 days, and that's industrials. I still like the sector because it's positioned way to the right, and we after 1, 2, 3, 4 days of losing relative strength, we now started to move to the right again. To the right means higher on the RS ratio scale, which means a stronger relative uptrend, or a relative uptrend that is getting stronger. So that is pretty good. No problem that we had this. Well, it wasn't actually underperforming. It was like right smack in the middle, in line with SPY. Technology underperforming, but not as strongly as we have seen for the last couple of weeks. And you see that this tail now is very short and hovering around that 100 level on the momentum scale. It is to the left, so it means that it is in a stable relative downtrend versus SPY, which is in the middle. But that downtrend is not getting any worse. So it's not the strongest sector anymore, that's for sure. We lost a lot. We'll have to see how that works out in the bigger picture, and maybe if we can find some positive things for technology going forward. For now, it seems to be stabilizing at a shallow relative downtrend versus SPY. We go to utilities. That is weakening again. We had a little bit of an uptick when the week started, and now we actually continue to move to the left, so losing relative strength. And the same goes for the healthcare sector, pointing straight into the lagging quadrant, losing relative strength, losing relative momentum versus SPY. It keeps amazing me. I mean, I think this would be one of the sectors that people would be betting on, with all the pharmaceutical, medical, healthcare type stuff going on. But the translation that I made in my head for this is that you got to be seriously picking, because there can only be, and I'm no expert here, but I think that the deal probably is that there can only be a few winners in this space, and they will be super winners, and the others will actually be strongly underperforming. Because if you find the vaccine, if you find the cure, if you have the good tests, if you If you do the good stuff, then you'll probably be picked up by the investment community. But that means that they're concentrating their bets on those single stocks, leaving less money to invest in the other healthcare stocks. And I think, or at least that's my perception, that is the reason why the sector as a whole is actually moving into the lagging quadrant. By the way, if you have anything to say and any views, put it in the comments below the video, and we'll have a chat about it. I love that interaction with you guys. If we go to staples, then that looks a little bit like technology. I mean, we're in the improving quadrant, but ticking right back, and it looks as if we're moving into the lagging quadrant again. So, that is not very strong. It's also underperforming since last week, so not much good there. Short tail, stable underperformers. And then finally we have real estate, which seemed to be picking up, and did that very briefly, but while it was inside leading for 2-3 days last week. 1, 2, 3, well, 2 days, because the third day is blue again. So we went back into improving, and now we're heading rapidly towards that lagging quadrant in which we entered last Friday, and by the looks of it, we'll continue into that lagging quadrant in the coming week. I am going to leave the overview at this. We're going to take the break early in this episode, because after the break I want to put all of this into a longer term perspective, looking at the weekly charts for sectors and combining that with, because it is the last Tuesday of the month, well, not really, it's the last Monday of the month that I'm recording, and tomorrow will be the first Tuesday, but for me it's the last recording of the last month, which means that we're going to look at the seasonality for US sectors. So stay with me for 30 seconds. We're going to go for a quick break, and after that we'll be bringing everything into longer term weekly charts, including the outlook based on the seasonality. We'll be back in 30 seconds. And welcome back. As I said, the second part of the show, we will dive into the weekly charts using the weekly RRGs, the seasonality spreadsheet for sectors, and the individual charts. Before we start looking at the seasonals and the sectors, I quickly want to highlight a few developments in the asset class rotation. On the left hand side, we now have loaded up the RRG for asset classes on a weekly scale, weekly basis. We saw the sort of confusion in the commodity indexes on the daily, but if you look at commodities, both GSG and DJP, you see a clear rolling over, rapidly losing relative momentum tails. So despite the short-term improvements that we see on those charts, I'm still pretty reluctant to go all in on commodities. I still feel that these tails are telling us that basically that there are other areas, other asset classes that are giving us better opportunities. Or maybe I should speak single asset class, but really the only asset class that is really strong and in a relative uptrend versus FBINX, that's the stock market, that's ITOT. And as you can see, we've been tracking that tail down over the last weeks. Well, maybe already like 2 months, like 1, 2, 3, 4, 5, 6, 7, 8. So that's 2 months. And then over the last 3 weeks, we now see that that tail has started to curl up rather sharply, actually, which is good news, because this means that the relative uptrend of ITOT against FBINX is starting a new lag higher, which speaks in favor of stocks over bonds. If we jump to the government bond tail, then we see the opposite, the rotation inside improving, moving downward back to lagging, and that actually brings the stock bond ratio, confirming that the stock bond ratio is moving further up. And let me quickly move to that chart, because that's this one here, and you can see that that break above previous highs is now really established. That previous level is around 2.87, should now act as support. That trend is now confirmed with new higher highs and higher lows. We had this, a couple of months overhead resistance that's taken out. So I'd say that that is really in favor of stocks very clearly. One more chart that I want to grab out of this is the US dollar chart, because against VBINX, it's actually rolling over, so it's continuing its underperformance versus the balanced portfolio. But if we look at the chart of the US dollar, and you see that it's breaking lower, and that is actually weakening versus the rest of the world. So other currencies are actually improving versus the US dollar. Let's quickly move to the sectors. And here is the sector chart. I'm gonna click away. I hope you all took advantage of that Cyber Monday deal. By the time this is airing, that is gone. Then we're on the holiday special, which is still a pretty good deal, but not as good as you could have got on the Monday, the Cyber Monday. Where is my spreadsheet? So here is the spreadsheet for seasonality. And remember, if you are interested in having this spreadsheet for yourself, just drop me an email. Let's have a look at the month of December. So the one that stands out is actually XLC, Communication Services. So here is December, and you see actually Communication Services at 77% of the historical months. It was an outperformer, which is pretty strong. Almost 60% for energy and financials, as well as real estate and utilities at 63%. So communication services is the outlier right now. That's really a serious number, 77%. And on the weak side, on the stuff that has been underperforming, clearly underperforming, we have actually energy, which is the lowest ranked sector in terms of seasonality. So historically, December was not a very good month for technology. Only 37% of the months XLK outperformed the S&P 500. So keep an eye on that. I'm gonna bring so we're gonna keep an eye on this, and then we're gonna bring in the RRG and see if we can actually find rotations that match this, and then I'm gonna particularly focus on communication services and technology and see if we can get alignment of interest there. Here is the RRG. Let's start with that communication services. Let's get that out of the way. And I think it's an interesting one, because we saw, we just looked at the daily rotation for XLC, and we saw that was moving vertically on that RS ratio scale higher, or on the momentum scale higher, and stable on the ratio scale. If you look at the weekly, we isolate XLC and zoom in a little bit, then you see that it has already turned back into that important 0 to 90 degree heading, and picking up momentum on the weekly as well. So if we look at the chart for communication services here, then that break is still there. We broke to new highs. We're actually holding up above those highs. So this is last week, and this is like Monday. This is today, only one bar, but the break is there. So if we are able to hold let's say around 64, if 64 support for communication services holds, we can move higher and we can see the relative strength line breaking above this overhead resistance line, then I think that the turn that we already see on the RRG, on the tail, could actually be the catalyst for communication services to move higher and be one of the stronger sectors in December going forward. Communication services is the weaker of the two that we've picked out on that seasonality spreadsheet. Now here is the daily tail on technology, moving to the left, inside weakening. And if we go to the weekly, then we see that technology is also inside weakening and moving further left. So there's not a lot of positives to come from the RRG. Both tails are in weakening, they're both heading towards the lagging quadrant. It will be very difficult for technology to put in a good couple of weeks to end December on a good note. Now if we look at the chart, and we have the price chart here, then you see, and we've talked about this before, technology has still not been able to break to new highs, and the relative strength line is now clearly below this rising support line, and essentially since August, 24th of August, on a relative basis, and also on a price basis, technology's gone nowhere. It's got a couple of swings, but not really a directional move. And you see that trend has now really come off and at risk of moving into the lagging quadrant. Add to that we have actually a pretty weak outlook for the technology sector going into the month of December, then I'd be very reluctant to add new positions to technology or hold it. I'd be very, very careful with that. If we look at the average performances, so here are the average numbers, the percentage outperformance versus SPY in December, then we see that technology is actually over the last, this is roughly around 20 years, underperforming SPY by 80 bips in December. So we have a weak historical seasonality pattern, and on average technology has been underperforming SPY by 80 bips. Communication services, on the other hand, has been outperforming SPY 77% of the occasions, and it's been outperforming 1.1% in general for the month of December. So this looks like a pretty good opportunity to be long or get exposure to communication services, and be very careful with the technology sector. And we can actually support that case by looking at the charts. So I think the most important message here is to be very careful with technology still, and look for opportunities in the communication services sector. Now, if we quickly move through the charts to put everything in a longer term perspective, we have industrials still inside the leading quadrant, losing a little bit of momentum. But if we look at this chart, that still looks very strong. We saw last week the break out of this triangle going higher. That still looks good. So we have this little pause in momentum that we see here. We see that coming back in that RS momentum line. For the time being, I'd stick with overweights, outperformers, long positions for industrials. Definitely as long as we remain above this previous resistance, now support in this gap area. I think that's a very important thing to watch. And the industrial sector's got all the room in the world to actually go through weakening and rotate back up to confirm that uptrend. As a matter of fact, you see that industrials is now, if we take the RS ratio as our yardstick, the strongest sector in the US. Let me go through this tail here. Now we go to energy. I'm going to fit this one here. Energy, massive rally again, but as we talked through it, we saw that the tail is still far away to the left. And if we look at that longer term chart, if you look at the tail of energy and the positioning versus the rest, it's completely disconnected. It's way to the left. And we can see why if you look at that relative strength line, because this is, no matter what sort of moves we had here, this is clearly a downtrend. So for the time being, and unless proven otherwise, I'm gonna still stick with the relative underperformance, and you already see here that the relative strength line is getting into trouble at this former support level, now resistance. So you need a hell of a lot of relative momentum to actually push this one all the way to leading. With this type of chart, this type of overhead resistance in price, I've got a very hard time seeing that happen anytime soon. So for the time being, I would still be very reluctant to get long-term positions in XLE. It's a great sector to swing trade or day trade or take shorter-term positions, but from a longer-term perspective, I'd still be very careful with that. Real estate, pretty similar, rolling over, insight improving, so it's actually looking as if it's ending its hiccup in relative momentum, and we see that here. We see that it broke that downtrend, or it broke that support here, pushing further down. RS ratio is rolling over, and I've seen this happening many times before. You try to break out, you try, it doesn't hold, and then very often we'll see a move all the way down to the lower end of that trading range, and combine that with the rolling over of XRE on the RRG, and that's a sector that's better avoided. Healthcare doing a similar thing. Again, as I said before the break, strange sector to deal with right now, but look at this relative strength. That's not looking good, guys. It's actually, and girls, I know there's a lot of women watching the show. This is not looking good, and it's looking as if it's going to break even lower. And here we're sort of trying to hold up, hover above this support level. If that doesn't work, then again, I think that relative strength will take the downturn and move even further down, supported by this rolling over here. Utilities doing the same thing, so it's pretty much all these sort of defensive sectors that are rolling over. You could interpret that as a good thing for the market because people are moving out of defensive, so they move to more offensive, not technology, but they move to communication services, they move to industrials. Materials is also still very good. So here you've got utilities. This is a nice trend, but the relative is really, really weak. Put in a new lower high, and we need a lot more to actually bring that back up. Financials is one of the better tails, one of the better charts. That's been holding up here. You saw that break. We're holding up here. Maybe a little bit of a setback coming, but look for support in the 2740 area to actually push that higher. So I know that I am now going rapidly over time, so I need to wrap it up. Be on the lookout for a blog in the RRG blog later today. No, not later today. It's going to be tomorrow. And sorry about the shortage of time. We looked at technology. I got to cut it out right now. I got to close it. This was Sector Spotlight for this week. We air every Tuesday, 10:30 to 11 a.m. Leave your comments below the video, and I hope to see you again next time with a new episode of Sector Spotlight.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.